How does Domino's Pizza do it? After seeing weakness from nearly the whole casual dining space, including direct competitors like Papa John and Pizza Hut, as I mentioned last week, Domino's still managed to report a dazzlingly better than expected quarter last Tuesday, including a fabulous 12% plus increase in domestic same-store sales. I keep telling you that Domino's is one of the best plays out there on the new stay-at-home economy, as their terrific technology makes it incredibly easy to order a pizza directly to your couch without ever having to speak to another human. Unbelievable, huh? Either though the company's excellent mobile app or their great website is the way to go. But don't take it from me. I've been recommending this stock ever since CEO Patrick Doyle came on the show more than 7 years ago when the stock was trading around $10. So it's nearly $190 plus some special dividends. Let's check in once again with Patrick Doyle, the bankable president and CEO of Domino's Pizza, to find out more about how the company's doing. Mr. Doyle, welcome back to Mad Money.
Thanks, Jim. Appreciate it.
All right, Patrick, this was one we've had many times where the industry's done well and you've done better than the industry. This is one time where the industry didn't do well and you did much better than the industry. What do you think was behind this double-digit comp gain that you had that took everybody's breath away?
Jim, it really continues to be the same story. I mean, it was investments that we've been making over the last few years in our food, in our technology, in our stores. You're seeing the results from that now coming through in the same-store sales growth, both domestically and internationally. So, we view ourselves as a work-in-progress brand. I mean, we continue to find places that we can improve the experience for the customer. And as long as we're making investments that do that kind of permanently improve the experience for our customers, then we think we're going to continue to grow.
Well, you list as your partners in this most recent call Apple, Amazon, Google, and Facebook. Those are not traditional restaurant partners. What do they all do for you?
Yeah, you know what? In all of those cases now, you can order on their platforms. And so we look at our ability to reach our customers. And, those are the platforms where they're spending time, right? They're on, they're on Alexa. They're on Google Home. They're using their iPhones to order. I mean, all of those things. They're ordering through Facebook Messenger. So all of those things are an opportunity for us to engage with the customers. Those are kind of the big players in technology, and we've got to be there with them, with our customers, if we're going to grow our sales.
Let's stick with this technology issue. If I go to your Ann Arbor headquarters, how many of the employees there would be considered technologists?
Yeah, basically half. We've got about 800 people working in our headquarters here in Ann Arbor, and 400 of them or so, including our contractors here, are working in technology or working in analytics around all of the data that's getting created on this platform. And, that's certainly a big part of the story. But at the same time, our franchisees are doing a terrific job of executing in our stores. They're making great pizzas. And, that's ultimately what keeps people coming back.
In the time that many times we've talked to each other, you've often talked about the advantage you have over the smaller regional and, of course, the mom and pops. This quarter seemed to be a different one. And you even mentioned that you felt that you took some share from the big guys. And I was on the Papa John call, and they were talking about an 8% decline in ratings in the NFL hurt them. I see your ads all the time in the NFL. Were you hurt similarly by the NFL's declining ratings?
No, we clearly were not. And, ratings may have been off a little bit, but, clearly we had a terrific fourth quarter. I will tell you, I mean, we did take share from the category overall, and maybe a little bit more of it came from the larger players this category. But if you look back over the course of the last 5 years or so, probably 80% of kind of the gains that we've had have come against the smaller players, right. The independents, the regionals. Much less of it has come from the larger players.
Okay, now, Pat, I know you watch this show. We've been using you as the keystone to this whole theory about the stay-at-home person. What happened in the culture? Why did this occur? We're out of the Great Recession. We know that people have more disposable income than they did, but there seems to be a major change in the way people eat and how they entertain themselves. Could you just give us your part of why you think we are a stay-at-home culture now?
Yeah, I think what's happening, Jim, is there is a great convenience now for ordering in, whether it's your food, whether or not you're ordering off of a website from any of the different e-commerce retailers. I think what you're seeing is people still clearly go out, but it's got to be special. there's got to be something special in a restaurant or in a retailer that's drawing people in, that's giving them this very different experience than simply going in and buying. And if they're just walking into a store and they're grabbing something off of the shelf, it may be easier to stay at home. And so same thing, in restaurants, I think if you're giving somebody a really special experience, then I think you're going to continue to drive traffic into your restaurant. But if you're not, it's terrific and simple and easy for people to stay at home and order in their pizza from Domino's. And so I think that's what you're seeing. I think if you've got a restaurant that is a sit-down restaurant that is not doing something really special, then I think you're going to hurt. If you're doing something that's giving them a better than average experience, it's something that's memorable for them, then they're going to invest the time to go out and eat in your restaurant. So I think you're seeing that split between convenience that is driving clearly our end of the business, or those who are doing a terrific job for that dine-in experience. And those are the people who are doing well. And you've seen fine dining has actually been doing pretty well over the course of the last couple of years. It's kind of the people in the middle that aren't doing something really differentiated that are struggling.
Did you see it coming? I mean, the technology spend was brilliant because what they're on is technology. They're on Facebook. You seem to know. I mean, are you going to do Snap? Do you have something with Snap going?
We're not going to talk about anything that we're doing going forward, but we clearly, we started investing heavily in technology, brought it all in-house kind of 7 or 8 years ago, and that's when we really started this journey. And it's interesting. I look at our business and how it's transformed from being majority over the phone to being majority digital. And there aren't a lot of players that have done that. You look at what Netflix has done, and I know is one you talk about as kind of this stay-at-home theme around investing. They went from a purely physical, sort of approach to digitizing all that, making it much easier. They're another one that's on that list. It's not a long list of people that have gone from being, kind of the old story to the new story.
No, it's not a long list, and you're at the top of it. Patrick Doyle, President and CEO of Domino's Pizza. Congratulations on an unbelievable quarter, sir. Great to see you.
Thanks, Jim.
All right, it's a juggernaut, and you see why. The moat just gets higher and higher, bigger and bigger. It's the technology spend. Hey, listen, it's also pretty good taste of pizza. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.